Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield. My co-host Judson Crawford and I are CPAs, wealth advisors, and partners at CWA, a financial services firm here to help business owners navigate the decisions they face every day. While Judson isn't able to join us today with the recent passing of Trump's Big Beautiful Bill Act, we knew we had to sit down and share the details on the pod. Even though I know Judson is actively reading all 300, 500,000 plus pages of this bill on his vacation, I've invited another special guest and CWA partner to join me today and fill in. Brian Bortz, welcome.
Hey, thank you for having me. I know that I won't be a fill-in for Judd, but I appreciate you having me.
Of course. And you've been on before, but I'm going to just do a little bio very quickly. I wore my Texas Longhorn shirt today, and just for you, because, folks, Brian actually graduated both bachelor's and master's from Texas A&M University, our rivals. He started at Arthur Anderson, may it rest in peace, and then joined EY, which is where Judson and I both came from. They're really working with high net worth individuals, which is where he then came over to CWA, and he's been here since 2004. He's an equity partner. He is the head of our investment committee, so we're together a lot as we work through strategy. Brian and his wife Tiffany have two children, Braden and Macy, and for those that don't know, he's a huge sports fan. Aggies, Cowboys, Rangers, Notre Dame, Lakers, Patriots,
Stars.
all the Tiger Woods,
Pretty much, yeah.
All the
Man City, whatever.
Yeah, Man City, all the normals. Okay, folks, the One Big Beautiful Bill Act, which is out, it was passed on July 3rd. Super important stuff, and there's a lot to unpack. I mean, we've talked on the pod really all year, Brian, about the estate tax exemption and all these other things. And so we felt like, you know, even with Judd out this week, we needed to get some stuff on paper and recording for folks.
Sure, yeah. You know, you're talking about the estate. It's crazy how big that thing is, and people think, oh, well, I don't have to plan. Every aspect of this bill has so many planning opportunities. So I'm sure we're going to dive into it and talk about it, but basically every paragraph has a planning opportunity.
Yeah, for sure. And I think, you know, a couple things, folks. Number one, this whole episode will be vital. So even if you've got to stop and come back to it, please listen all the way through, because we're going to kind of go provision by provision. Number two will be a little bit longer than normal, but again, super important. So make sure you come back to it. Number three, we are not going to talk about the changes to student loans, which are robust, as we might say.
Yeah.
Which we teased that. We had Austin Scott on earlier this year and talked about the potential changes coming, and a lot of those did come. So we're going to do a completely separate recording on that. So, you know, feel free to come back and listen to that. We are also not going to talk about the Trump accounts, Brian.
Dang it.
Because there's a lot there too, right? We're going to do a full episode, not a full episode, but we'll do a separate episode on that one.
We'll postpone my $2,000. That's fine.
Yeah, exactly. So a couple of summary items, folks. I'm going to walk us through this bill, and then Brian's going to come in with strategy as well. We'll dialogue back and forth, but it was passed on July 3rd. The actual name of the bill is the One Big Beautiful Bill Act. So this is a nonpartisan name. That's like the actual bill when you go in and look.
It's big, it's a bill.
Some people may or may not think it's beautiful.
Yeah, we'll see.
But that's like the name. So we're going to call it the OBBBA. Gosh, that's so awkward.
That's a lot.
We'll just call it the Big Beautiful Bill, I guess. Page count came in at 330 pages, which I don't know, maybe we think that's long as far as things go. I just did a little dive, Brian, on some past bills.
Okay.
Yeah. The longest bill ever is the Consolidated Appropriations Act in 2021. It is 5,500 pages.
Interesting.
Indeed.
Did you read those?
No.
Oh, okay.
No. I read the AI summary that didn't exist in 2021.
Right.
Affordable Care Act, 2,500 pages.
I've heard of it.
So like 10x the size of this bill, which is crazy. Let's see what else. Dodd-Frank was 1,800. Bill Clinton's health plan, 1,300. I have two others that I'm going to give you. Number one, the original Environmental Protection Act of 1970.
I will say 1,342 pages.
4. You were 1,338.
Dang it.
Over. You would have lost in Price is Right. 4 pages.
Wow.
To protect our environment.
Makes sense.
Shame on Congress. Brian, what was the original length of the 1913 personal income tax bill? Very first one.
A paragraph.
A paragraph. 14 pages. I'm like,
Pay
what did they write? It was probably very beautifully written, though.
Yeah.
Thou art the income tax. And
the
then
signatures were pretty.
one paragraph.
Right.
All right. It was 14 pages. We got 330. So while it is big, it's not near as big as some of the other ones. Okay. A couple things here, Brian. Number one, let's talk a little bit about, we started with the Tax Cuts and Jobs Act that was passed 1/1 of 18. And that was, as we've talked over and over on the pod, set to expire at the end of 2025. Talk a little bit about what does this bill do to that?
Sure. Yeah. So both for business and for personal provisions within the bill, this bill's intent was to make a lot of things that were in the Tax Cut and Jobs Act permanent instead of having them expire. The reason they expired before was because there's a process in Congress that if a tax bill doesn't start with the House Ways and Means Committee or the Senate Finance Committee, it can't be made permanent. And so it had to expire after no more than 10 years. So it was going to expire, and all the rules were going to go back to where they were 10 years ago, which this administration did not want to have happen. So he laid a deadline out, wanted to have it happen by July 4th. It happened on July 3rd. Amazingly enough, when you put a deadline to something, things get done. So all of this bill is really just making everything permanent that they wanted to make permanent.
Yeah, or not making permanent things they didn't want to, right? And when we say, hey, we've now made this provision permanent, right? So we'll start here very quickly with the tax brackets. So the tax bracket changes in the Tax Cuts and Jobs Act, those are now permanent. What does it mean when we say permanent?
So they're not going to expire. They can be changed by a new law, but currently you're going to have a top tax bracket that's 37% as opposed to going back to 39.6. The other thing to keep in mind with the tax brackets is that there's kind of a big fat middle, kind of like me. And you have a couple of those brackets that capture a lot of different incomes. So yeah, it starts at 10%. Yeah, it only goes up to 37, but kind of the big fat middle is where a lot of people get caught.
Yeah, and so let's go through those very quickly. Again, we're now permanent. Our brackets are 10, 12, 22, 24, and then we got our big fat middle. It goes from 24 to 33.
Right.
Big jump there. We were going up 2, and then we went up
A bunch.
And then 33 to 35, and then 35 to 37. So again, those are your marginal rates, folks. Those are now permanent, absent, as Brian said, another bill coming in. Okay. Other things that were made permanent, just very high level. The itemized deduction rules broadly stayed the same. There are some small changes, but most of those things stayed the same, and we'll go through those small changes here shortly. And I think the last one, which most of our clients, didn't really benefit from anyway, but the personal exemption deduction was eliminated permanently.
Sort of.
Yeah, good point. Sort of.
So I work a lot with retirees. That's who most of my client base is. And so there is an exemption if you are 65 years and older, that you have a $6,000 exemption, which is above a line deduction, reduces your income, pay less tax. And if you are married filing jointly and both spouses are 65 or older, they actually each get $6,000, so they could have $12,000 of reduction.
Yeah, and that's going to end up being, we were going to talk a little bit later about it, that's going to end up being kind of the no tax on Social Security provision.
A little bit, yep.
Yeah. So, So again, those are some of the things that really didn't change. They were just made permanent, which is great from our perspective to know, all right, here are your tax brackets. I think, Brian, you and I both, we've been doing this over 20, 25 years, and you're like constantly, okay, what are the brackets now? Now they're just permanent, and we know what they are, which is helpful. Okay, so we still have a ton of different places to go, including a state, but I think the biggest one to start with is the state and local tax deduction, or SALT. This is one that has been kind of all over the place, and when it was originally capped at the 10K, again with Tax Cuts and Jobs Act, it introduced the concept of PTE, which we were praying would go away. And unfortunately, it just got more complicated.
Yeah, it's interesting that living in the great state of Texas, we don't have a lot of issues with state income tax, but a lot of you out there do. And in those states that have a higher state income tax, this original limitation of $10,000 really kind of squeezed most people out of being able to deduct state taxes. So that's how PTE came about. The states took it upon themselves to allow you a deduction within your corporation, and then you could take that deduction. Well, now you're increasing this limit from, instead of being at $10,000, which is a very low limit, up to $40,000. It's a very large fourfold increase. There are some rules, and if you're above $500,000 of modified adjusted gross income, check with your planner on what that actually means. Then you start to get a reduction of your $40,000 by 30%. And so, there's a calculation. Of course, it's the tax rules, so there's going to be a calculation. But the long and short is that you're going to get more of a state and local tax deduction, which is great.
Yeah, let's simplify this, listeners. If you have tired head from this, we're going to make it real simple. Number one, everybody's going to go up to $40K on state and local tax deduction unless you make more than $600K, at which point it's now $10K. All right. So that's the super simple approach to it. Let
me add one more thing.
One thing. Sorry. Hold on one second.
That's fine.
One thing to understand before we dive a little bit deeper in the rules here. One thing to understand is one of the big fears of all of us on this front was that the SALT deduction was going to kind of be added back, but they were going to take PTE away. Miraculously, both the House and Senate bill sort of had in there, hey, PTE is going away. And then when the final bill passed, PTE wasn't taken away. So again, hear me loud and clear. No matter what, you are still going to get to deduct your state income taxes paid. We are either going to do it via the new increased exemption or PTE or a hybrid. So I personally am going to retire now because I'm already getting tired head thinking about this. But the strategy on this is going to be very, very nuanced because, look, if you're over 600K on income, you're just going to do PTE. It's that simple. If you are under 600K, especially in that 5 to 600 range, there's going to be this like really complicated balance of how much PTE do I pay? Because on the other side, I'm going to get the state and local tax deduction as well. So again, folks, like we'll be here for you. And for those that are not clients, you have got to get with your CPA to really understand this. And it needs to be done quickly because guess what? This is effective in 2025.
Right. Well, and that's kind of what I wanted to add. Not only are all these rules very nuanced and can be complicated, depending on which section you're looking at, the rules either start in 25, some of them start in 26, some of them are permanent, some of them go away in 28, some of them go away in 2030. So you really have to pay attention to how the rules are written. This particular rule, if it's not changed, the SALT deduction goes back to $10,000 in 2030. So expect to see some more legislation before then. Expect to see my retirement notice noted before then. So yeah, again, for the next 5 years, folks, let's just make it super simple. If you're between that 5 and 600 range, there's going to be some nuance because essentially you're going to get a 30% reduction all the way up to the 600K, at which point it goes away almost entirely down to the 10K. So there's a lot of strategy there. And if you've just been working with your CPA that's not a Kane Waters person on just, hey, I just pay my PTEs and it's all good, that is no longer the rule. Like now it's going to be quite a bit of complexity on calculating how much PTE versus a SALT deduction. But bottom line is that it is increased, which is great. And even if you get exempted out of it, you'll still have PTE. Exactly. And super helpful. No one is going to be the worse for this change. Except for us. Okay, so moving on from SALT, which is great. It is honestly a good thing for our clients that are in high state income tax states. Moving on from that, let's go to QBI real quick. Now, QBI, qualified business income deduction, is not one that many of our clients take advantage of because they phase out on an income standpoint. Right. That being said, it's estimated about 25 million taxpayers did take advantage of it in 2023. And some of you in here that might be in a lower income spot in life or might be living off just interest income and some small business income as well, you may still qualify. So, Brian, let's talk a little bit. Why don't you give a quick summary of like what increases came to QBI? Sure. For the benefit of potentially some of the listeners. Yeah. So QBI stands for Qualified Business Income. It is a 20% deduction, and that deduction was made permanent. It is phased out for increases for $75,000 for single filers, $150,000 for married filing jointly filers, But keep in mind, this is one of those rules that only start kicking in 2026. So it is not a this year rule. There's a lot of planning opportunities, Hunter, with this. You as a planner, we can determine whether or not your client should receive income from a W-2, should receive income from a K-1. There's different rules that will affect your QBI with that. So, there's definitely reasons that you want to get together with your planner and talk about qualified business income. But just keep in mind that there are phase outs on this as well.
Yeah. And I think most people will be phased out, but don't ignore it, to your point, which I think is one of the reasons why we're always proactively planning in our meetings so that we're ahead of things so we can make decisions accordingly. So that's sort of the QBI changes. Very quickly, let's talk no tax on tips and overtime, because that was obviously something that he campaigned on and has been a buzzword. So first off, folks, this is only going to be through 2028, and it's only income tax, right? So you still have to report your tips, and you still have to pay self-employment or payroll taxes on those. However, if you've got taxes and if you have tips and overtime, it's actually going to be a deduction of a set amount that will phase out against your income to give you that benefit. So, and in fact, Brian, we don't even know, like, it was also, the tips have got to be in the normal course of business.
Right.
So Kane Waters, we do not receive tips, so we can't change all of our fees to tips.
True.
And they were going to give they're going to release in the next 90 days a list of people who would qualify for this. So this is not truly set in stone yet. And really for 99% of small business owners and our clients, there's no benefit here.
That's right. Yeah. I tell you who does benefit is my daughter, Macy, who is a hostess at a restaurant. And there is occasionally times where she gets tipped for her service. So that's one of the things. It's really service interests, restaurants, valets, things that people get tipped all the time. So
yeah, more to come on the tips and overtime, folks. It is in there. So is the Social Security, but it's sort of it's kind of a not directly stated. You kind of have to get to each of those points. And again, most folks are not going to have necessarily a benefit from it. So, all right, let's move on to charitable deductions. This is actually one that I don't know that I saw coming by any stretch, but is significant for some of our clients. And so I think the first thing with charitable deductions, folks, remember that you get to deduct only if you itemize historically. You get to deduct gifts to charity. And so if you do not itemize, if you just take the standard deduction, maybe you don't have mortgage interest, you don't have state income taxes, your property taxes are pretty low, so you always itemized, you've never received a benefit for your charitable giving until now. Until the OBBBA, which now gives us a new rule that no matter what, if you take the standard deduction, you can take a $2,000 deduction for married filing jointly for any giving. Now, this one is super important because, and this starts in 26. Right. All right. This one is super important because for a long time, my clients that don't itemize, they don't even keep receipts for giving. And now they definitely want to keep them up to $2,000 because that $2,000 could save you $600 to $800 in taxes. So unless you hate money, you probably should do it.
I mean, if I saw $800 laying on the ground, I'd pick it up.
Yeah. I mean, you just pick it up and tear it in half.
I would.
Just light it on fire.
In front of somebody. Yeah.
No, for those that don't know Brian, what Brian would do is he would pick it up and then he would go to a casino and put it on red.
Potentially.
Okay. So that's the first thing. Now, in order to pay for that, they took something away from all of the itemizers. How about that? No. So for those that itemize, historically, you have been able to deduct all of your deductions. Unfortunately, now we have a brand new floor of 0.5% that you have to go over. What the heck does that mean? So here's just a simple way to look at it. If you make $200,000, if that's your income, 200,000 times 0.5 is $1,000. So your first $1,000 of giving is now not deductible, whereas historically it was. So if you give $10,000 of your $200 to your church or your kid's school or the Red Cross or whatever, you only get a $9,000 deduction, not $10,000. Now, most of my clients are not giving for a tax deduction, but it is money that is no longer deductible for them. And so again, it's only everything over the 0.5.
So let me get this straight. So if I don't itemize and I give $2,000, I don't get all $2,000 still because it's
you do get it. It's only for those darn itemizers.
There you go.
They get capped at the 0.5.
Okay.
Which makes no sense, but whatever. I think it's encouraging larger giving. It certainly is finding a way to pay for some of the other things like no tax on tips, no Social Security or whatever else. Because a lot of folks that make a lot of money and give a lot of money are not doing it for necessarily the tax deduction.
Right.
But it is something important to understand. So I think, again, this one starts in 26. I think it makes a lot of sense at 25. If you normally do a bunch of giving at year end, make sure you get it in at year end because you won't have that limit, in 2025.
Yeah, one of the things too to keep in mind, Hunter, is that it's going to become harder and harder for some folks to itemize because the standard deduction has not only gone up, it's also the increase has been made permanent and going to be indexed.
I was going to go there next.
There you go.
It's like we've been doing this our whole time, our whole lives. Okay, why don't you tell them? So standard deduction went up. Let's
deduction.
Do it.
So if you are married filing jointly, the new standard deduction is $31,500. That's a big number, actually. So you think about whatever your taxable income is, and then you're going to, your adjusted gross income is, and then you think about deducting $31,500 off of that. Well, in order to itemize, you've got to be north of that number. Well, if like you said earlier, if you live in a state that doesn't have state income tax, maybe your property taxes or your mortgage interest is not very high, and you've given, but you haven't quite given $30,000, you may not itemize. And so a lot of these changes that are affecting Schedule A or the itemized deductions page may or may not apply to you because the standard deduction is so high now.
Yeah, and it's a good thing, I think, broadly. Yeah. I mean, it should simplify tax preparation for a majority of Americans that don't itemize because it's going to be, or were maybe previously itemizing because they were just over the standard, and now it's like they're going to be under the standard. It makes things a little bit more simple on the personal tax return. I also love that it like indexed it. It's permanent. It's just going to be there as like this sort of anchor to folks' tax returns.
Yeah, and I talked to several of my clients, and you would be surprised how many folks are actually caught off guard by the fact that they haven't gotten to deduct their charity, for example, what we just talked about, because they don't itemize. And they're like, what do you mean? I'm not itemizing. Well, your standard deduction is really big now. So,
yeah, and now you just give at least $2,000 and you get to.
There you go.
How about that? Or starting in 26 at least. Okay, so that's good. And the next one I was going to go to is the auto loan interest deduction, which is brand new.
Yes.
There are all kinds of qualifiers, which is why bills are 330 pages instead of 14. There are all kinds of qualifiers, and I'm sure there is more to it. In fact, folks, in reading the provision, you actually have to, if you buy a car and want to deduct the interest on this, you actually have to report the VIN, the VIN, on the tax return. And so, I mean, that is how nuanced this is going to be. I think the first thing to state, though, Brian, is there is an income cap on this.
Yes.
And so for a lot of folks, and it's only for like a 4-year period, and the car has to be made in the United States and all these different types of things.
Assembled in the United States.
Excuse me, assembled. Very good. Yes.
So there's a company called Kia, which is not a U.S.-based company, but they assemble everything in Georgia. So they would qualify.
Yeah. Well, and I think that goes to, like, Judson and I always talk about, like, with laws, understand the intent of the administration. What they are trying to do is drive manufacturing and assembly in the United States. They want factories, they want jobs, they want all of these things. So their hope is this incentivizes car companies to assemble here so that when they're selling these cars, they can market, hey, you get a tax deduction for the interest. So let's go through the specifics here, Brian. We do have a cap on income, and we have a cap on interest as well. You want to talk about those real quick?
Yeah, so you are able to deduct the first $10,000 of interest on a new automobile. All of these things are all part of the nuance. A new automobile that is purchased, it has to be assembled in the U.S., and this amount is phased out for anyone who has modified adjusted gross income of above $200,000 if you're married filing joint. So, you know, if as our clients, if you're making more than $200,000 on your tax return as a married filing joint client, this does not apply to you.
Yeah, and the phase out is done at $250,000. So if you make more than $250,000, your deduction's real easy to calculate. It's called zero. Okay, Brian, let's do a little question and answer.
Okay, let's
How
see
about
if I
that?
can do this.
Brian, I bought a car, and my car is financed.
Okay.
And
New car?
it was a new car.
Okay.
Yeah, it's a new car. It was financed. I make $400,000. It was assembled in the U.S. and my interest was $8,000. What's my deduction?
0.
Oh, okay. All right, let's do this again. I leased a new car.
Okay.
It was a new car though.
Oh,
and it
okay.
was assembled in the U.S. and my income's 180.
Yep.
And so I get to deduct the lease payments, right?
Absolutely not.
Oh, okay.
So leases are not applied to this.
Yeah. So again, folks, all this is purchases assembled in the U.S. new, and you got to make less than $250 or there's no deduction. Please hear those words and don't email us if you make more than $250 or you bought a used car or you leased a car or your car was assembled in the not in the United States.
Yeah, if you're buying an Audi or a BMW or a Porsche or anything else that's not assembled in the U.S., don't try.
If you have questions about any of those scenarios, please email Mason at King Waters. He'd be happy to answer those. Otherwise, do not email me, clients. Please, please, please. Okay. So that's good. We did autos. We got Social Security, standard deduction. We talked about those things. I think, Brian, largely that covers the personal things. I guess we could do child tax credit real quick.
Yeah.
So child tax credit, folks, remember, is not a deduction. It is a credit. So it's a dollar for dollar reduction on your taxes. And so we do have phase outs there. We do have income thresholds, but we also saw that go up, which is quite nice. You want to go through those real quick?
Yeah, so instead of being 2,000, it's now 2,200. It's gone up. And let's see, you're talking about phase outs? Boy, they're all over the board here. 200,000, there it is.
400,000 married filing jointly.
Right, 200,000 single, 400,000 married filing jointly. The other interesting thing about this, and again, this was brought on by the administration, there are a lot of provisions in this bill of which you have to have a Social Security number. And there's a reason for that, as you can imagine. So you have to have a Social Security number. The child who you are claiming the credit for has to also have a Social Security number as well. So there are some rules to the credit.
Yeah, but it is good to see that it has gone up. Again, we're incentivizing having kiddos and things like that, which is super helpful. So, okay, folks, last couple personal ones before we get, again, we're not covering student loans. We're not covering the Trump accounts. Last couple personal ones before we get to some business ones on homes. So home equity loans are still going to be deductible only if you are using it to improve your primary residence. So if you've got a HELOC, we've talked about this before. If you've got a HELOC and you're taking debt out to go buy another business or buy a car or to go put it on red, unfortunately, those things are not deductible from an interest perspective. But if you're using it to improve your home, that is now set in stone, permanent, which is awesome. In addition, mortgage interest deductions, the mortgage interest deductions are going to be permanent and locked in on $750K of mortgage debt. And so that one's locked in too. That was up for debate on whether or not that would increase or decrease. And I think the final one, Brian, that I thought was interesting is now you get to deduct mortgage insurance premiums.
Yeah.
Which is brand new. That was never the case. So folks, if you are financed more than 80% of the value of your home, you are paying a mortgage insurance premium to your mortgage provider, the bank. Those have never been deductible, and now they are. I think, again, it incentivizes folks to go out and secure loans and buy houses.
Right, yeah, and that's the entire intent of this is to drive housing up and to keep people buying houses.
Okay, we're cranking here, folks. Stick with us because, drum roll please, Brian, it's estate tax time.
Right.
And we're gonna do estate tax real quick, and then we're gonna go to business. But really positive outcome here, Brian. And what we've been talking about this all year. We've had Micah on, we've had other folks on to talk about this, and we felt very confident that this estate tax was going to be permanent and increased. So let's give the listeners the final answer on here.
Yeah, it's funny. Hunter loves to tell everyone in the audience how old I am. So when I first started here at Kane Waters, the estate exemption was a grand total of $650,000. It is now starting next year, actually starting this year, it is now going to $15 million each. So I would have $15 million and my wife, Tiffany, would have $15 million. So as a married couple, we'd have $30 million in our
I'm so impressed you were able to do that in your. I mean, you're an Aggie and you did it in your head.
I didn't even have to take a shoe off.
15 plus 15. $30 million.
$30 million.
Again, I think this is really good for a lot of high net worth who, look, I mean, 30 is a bunch. I mean, you've got to have it. You've got to have it outside of, all kinds of various things. It's all investment accounts and things like that. But 30 is a lot.
That's Hunter Satterfield money.
And so I give Hunter Satterfield in like 40 years. So I give that number to say this does take, it allows estate attorneys, us, our clients to sort of take a deep breath and say, okay, this is really good. That being said, and it is permanent and it is indexed for inflation. That being said, we should still look at estate plans, right?
Yeah, I think the most common misnomer with this provision is that, the estate limit's super high now, so I don't have to worry about it. And nothing could be further from the truth. There are a lot of states out there that charge their own estate tax at the state level, not at the federal level. This bill only addresses what the federal exemption is. So there's still planning required for that. There's also a lot of other planning that needs to take place, and it's been a focus of our firm, as you could tell from your podcasts and talking to Micah and everything else, making sure that the structure of your estate is correct and making sure that you have revocable living trust when needed and things like that. So, absolutely everyone listening to this, you need to take this as an opportunity to talk to your advisor about whether or not you need to look at your estate plan this year.
Yeah, I just need to stop very quickly. You are going to be removed from the podcast effective right now because you said revocable, which Judson and I are very much on the record. The word is revocable.
It's not.
It is.
The legal word is revocable.
Yeah. No, we've talked about this.
Irrevocable.
It's revocable. I'm so happy.
I went to Texas. I went to A&M.
About the estate changes. I'm so unhappy about PTE. Shame on you, Congress. But I'm very happy about estate. Okay.
Yeah.
There will be still tons more folks on estate. We're always going to cover that here, but we're really, really, again, very happy about where that one ended up going. Let's take a turn. Let's do business.
Sure.
I have a stat for you.
Okay.
I had to go look this up.
Stats.
But when I was in university and you were at Arthur Anderson, may I rest in peace, the Section 179 deduction in the year 2000, which is the, if you buy, everybody knows this, but if you buy equipment, if you put a building in service, all those things, you get to deduct as much as you want in year one up to a limit under Section 179. Brian, in 2000, the limit was $20,000.
I was going to either say 20 or 25. I didn't remember. Yeah, it was really, really small.
$20,000. The OBBBA,
well done.
Thank you, has changed that to all the money.
Slightly.
Yeah. You want to give everybody what it is?
It added a few zeros, and it went up to $2.5 million.
Oh, okay.
Yeah, just a little bit.
Just a few
bigger.
zeros.
Yeah. Couple of commas. It also looks at kind of a property threshold as well, a certain amount of property that you can look at, and that number went up from 3 and change up to 4 million. So keep in mind the deduction now can be as high as 2.5 million, meaning that anything that's placed in service, important word, in 2025 or later can qualify for this accelerated depreciation. Always keep in mind what that means, though. Accelerated depreciation means I get to take the deduction now instead of over the next 5, 7, 9, 39 years. That isn't necessarily the best thing to do if you're not paying cash for it. If I pay cash for something, I pay $2.5 million of Hunter cash up front, and I want to take that $2.5 million deduction. That makes sense. I'm timing those things together. But if I finance that $2.5 million over 10 years and I take all the deduction in year one, I'm making all those payments in years 2 through 10 with no deduction. So the timing of those and matching of those still matter, but that limit is a lot higher now.
I mean, we are all on record here at Kane Waters. We are in favor of this thing being unlimited. I mean, honestly, like being able to have flexibility and optionality of how much to deduct when on a project incentivizes business owners to go build and add and improve and invest in their business.
It's exactly what you said earlier, that the intent of this law was to drive capital investment, and that's what this will do.
Yeah, I mean, exactly. And so I think, folks, the subtle nuance to this is, Brian talked about timing it with your debt repayment, but I also think, I mean, look, given all the other things we talked about with AGI phase outs and all the different things, there's going to be a lot of opportunity to be creative with deductions in order to maximize all of those thresholds, which is, again, what we'll be doing for you, and we'll be doing that on a proactive basis. But do not sleep on this. This is going to be huge for folks because it's set in stone and it's going to be there for a long time.
Yeah. So Hunter, I have a question for you. Is this thing that we're talking about, this $2.5 million for Section 179, I think you said, is that what's called bonus depreciation?
No, it's not. In fact, in addition to that, it's a great segue. In addition to that, we have this thing called bonus depreciation, which unfortunately was decreasing. It was decreasing over the past handful of years. So it used to be 100% of property placed in service. So you could take not only the Section 179 of 2.5 million, but then you could do additional bonus depreciation as well of 100%. That was reduced to 40% in 25. It was set to go to 20% in 26 and 0 in 27. And they basically made it permanent at 100%.
All right.
Effectively, anything you do, build a building, buy equipment, do a new build out or whatever else, is going to be 100% deductible whenever you want it to be.
Right.
Huge win. And we no longer have to worry about, like in the past, where it was like, I don't know, it's only $20K. We got to time our deductions. None of that junk anymore. Okay. On the business front, we already talked about QBI, which is great. We already talked about PTE, which is terrible. It's good for you guys, listeners, but it's terrible for us.
Right.
I think the last one, Brian, is meals.
Okay.
And this one is complicated. And if you Google, listeners, can I deduct my business meals, you're going to get 6 different answers because the bill itself is very convoluted in how it. I mean, you and I even had disagreement as we were going on. I think you're correct. But I think the key here is to remember that this OBBBA is making adjustments to the original Tax Cuts and Jobs Act.
Right.
And so the way the actual new OBBBA reads...
You say that well.
I'm practicing. It's like banana.
Yeah.
BANANANANA.
Right.
The way it reads is it's going to allow deduction of employer-provided meals for convenience going forward. You want to talk about some of the nuance there? Because this was going away.
Yeah, and I think, Hunter, actually, I think you're burying the lead because the whole bill, what you just talked about was like 2 sentences in the bill, and then the rest of this section talked about if you worked on a fishing boat.
Oh, right, an oil rig.
So
I was like, that's good for all of our oil rig and fishing clients.
Fishery clients. But yeah, the long and short is that as long as the meal is provided at the convenience of the employer, so in other words, it's a business-related meal, it is 100% deductible, and that's been made permanent.
Yeah, and that's a big win. And clients, before you email Brian and I asking about entertainment, you don't get to deduct it. It's gone. It's been gone for a long time. No sports tickets, no Coldplay tickets. Oh, burn.
Ouch.
I did that.
Well, I will say, if you do need to email me again, I'm going to give you my email address. It's mason@canewaters.com.
That's right. Always go to mason@canewaters.com. Okay. All great stuff, folks. Again, there's still tons more in the bill. Again, a lot on student loans, these new Trump accounts. There's some other small things, but these are the ones that I think matter for everybody listening. And I think, again, the big thing, I'll give you a couple calls to action very quickly before we wrap. The first is we do have a detailed blog that's out there, canewaters.com/digital blogs. So make sure you go and read that. There's more to it in there. And the reality is we're following on top of what we've done for the last 6 to 8 years, which is this podcast is free. Our blog is free. We're just trying to bring the sort of simplified knowledge to everybody, whether you're a client or not. So go figure that out. Look, also, if all the stuff in here, you're like, man, there's so many changes coming and my CPA is not going to have these things. They're not going to be prepared for it. Guess what? We have room for you. So come on over to Kane Waters. We're happy to work with you proactively on planning. It's incredibly important given this new bill. We know it better than most out there. Our team does. So I think that's the other big one. At the end of the day, folks, we'll continue to talk through a lot of these different things as we go on future episodes. But it's good to have you, Brian.
Yeah, hey, thanks for having me. I appreciate it.
Indeed, expert on all the stuff, which is great. And we'll be back next week with both Judson and I to talk through some more stuff. So, as always, the best way to keep up with us is to subscribe to this podcast. That way you'll never have to miss an episode, and you can go back and listen to all the others. If you're enjoying us and all of our jokes and tax knowledge, leave us a review. It will make our day, really. If you've got a question, comment, or suggestion for a future episode, drop us a line at canewaters.com/wealth. And if you want to learn more about what we're doing, we're not recording this, listening to 300 or reading 330 pages of the OBBBBBBA, visit canewaters.com and see how we are helping our over 3,200 clients with their long-term financial goals. Thanks a lot.